Welcome to The Link this week. As you notice out there, there's a lot of politics going on, but business must go on because COVID came and encumbered businesses in ways that we can never imagine. And yet we need to talk about business because that's where the money lies and that's what keeps lives, households, and so on going. Tonight we're speaking about something you might have heard about, something called a bid bond. Banks advertise these things. Tonight we're going to understand what are they. Do you need a bid bond? If you do that, if you need it, how does it help you and so on. Tonight my guest is Mr. Cuthbert Semwanga, who is the manager trade finance in DFCU Bank. Mr. Semwanga, welcome.
Thank you so much, Mr. Ssettumba.
My OB. It's a very small town,
Very big coincidence.
Absolutely. Tonight we are going to teach some people. We are going to teach people about this issue. Bid bonds. People, we hear a lot of adverts about bid bonds. What is a bid bond? Let's start from there.
Right. In simple terms, really, a bid bond is just some kind of commitment that the bank gives on behalf of the customer.
Okay.
Who might be in any kind of supply or contract business. So that assurance is given to the employer or the owner of the contract that the customer is a serious bidder and that basically, I mean, they have a firm backing from the bank and they are financially stable. And I mean, as part of the process of bid evaluation,
yes,
they will be able to meet all the requirements.
Okay.
So that backing, in a way, I mean, is just meant to be, I mean, some kind of isolating factor or benchmarking against the non-serious bidders. You know very much that there are many briefcase companies in this market. So, I mean, just assume that a given contract, a given employer, I mean, put out a given bid, maybe calling upon service providers to execute a particular contract, okay, or to put in their interest. Possibly many briefcase companies would put in their interest, but that would be very time wasting for the employer or the owner of the contract. They only want to, I mean, go into the bid evaluation process with only those contractors that at least fulfill some minimal requirements, including being registered.
Okay.
So that bid guarantee, in a way, I mean, supports the contractor in terms of backing. That, I mean, given that they have the banking, they have the bank support and backing, these are really legitimate companies, and they are worth, I mean, participating in the bid evaluation process.
Mr. Semwanga there, so who do you give a bid bond? I'm just enjoining with what you just said there. Who qualifies then? So
basically, customers that do qualify, first of all, for you to be able to get a bid bond from the bank, you must be having a bank account.
Okay.
So the company possibly should be having a bank account already. So by the time we give you a bid bond, we already have enough information about your nature of business.
But I'm not fake.
What you correct, what you do, who are behind the business, I mean, what are your motives. So by the time we give you that kind of support or some kind of undertaking for to the employer or to the owner of the contract, you first of all, you must be having a bank account. So part of the qualification is having a bank account with us. Okay. Then the next stage is basically for you to go through the process of the bid issuance itself. Okay. And that includes for you to have submitted a formal application. We have a standard guarantee application form. So you fill in all the details.
So I must show you that I have applied?
Yes. We must have documentation to show that, I mean, you've put in a formal application, you've given us the information relating to the bid, how much bid is required. Just know that every bid, I mean, bids carry an amount, a nominal amount. I mean, should the employer put in a claim, there has to be an amount that is payable by the bank. And this amount is usually in the range of 2 to 5% of the anticipated contract price, which will be stated by the employer. So for example, if the anticipated contract price is roughly 100 million, and the employer specifies that all bidders must submit a bid guarantee or bid bond of 2%.
Yes.
So all bidders will submit. All bidders intending to bid for that contract will submit a bid bond of 2% of the 100 million.
The 100 million, which is 2 million.
Which is about 2 million. So that is, so all bid bonds will have an amount.
So the bank doesn't give me cash, but they give you some kind of paper.
It's just a paper.
That tells the person who is giving the contract that we know this person.
Correct, but it is a commitment in itself. It carries a serious commitment. And the wording is really some kind of commitment to say that, I mean, this we give the undertaking to pay you should this bidder not follow all processes of so and so within the bid evaluation process. Now,
that is the risk to the bank. What is the for the bank to allow to give me that risk? What do they want from me? I know it's about the conditions of registration, but what else do you want from me so that you can risk for me like this?
Well, that's a good question. Now, you know, basically, it's DFCU, if I can speak about specifically DFCU, I mean, we have taken time to understand the requirements of the market. We have also taken time to understand, I mean, how can we support, businesses to grow? How can we be able to put our foot on the ground? To go through all the levels.
To be there for me.
To be there for you as a company. Because we know that, part of the requirements, for example, of attaining government contracts requires that all bidders, all contractors must go through some kind of competitive bidding process.
Absolutely.
As for transparency and equal opportunity to all companies. So DFCU really sat down and realized that, if we are able to achieve that, then we must offer unsecured bid guarantees of up to our current limit now for unsecured bid guarantees is 500 million. So meaning that, we have taken a position.
If the 2% or 5% was 500 million, would commit?
Yes.
Okay, very interesting.
So
we need to move on, Mr. Semwanga, on the other second animal. Performance guarantee.
Yes.
We have like 3 minutes. What's a performance guarantee? The other one is a bid guarantee. This is a performance. What's the difference?
The difference basically is in the actual wording. First of all, the bid guarantee is just in the bidding stage. So even the wording itself will be different, but also in terms of commitment. A performance guarantee will come at a stage when the bidder has been nominated as the best evaluation bidder.
Basically awarded the contract.
Yes. So at that point now, the employer will now put all the focus onto you, the win of the contract, and then now you'll start a journey where you have to provide, some kind of comfort that you will be able to execute the contract. So that performance guarantee is a commitment that now the contractor has the backing by the bank based on our knowledge that they have performed before such contracts, that they will perform that contract. And should the contractor not be able to execute the contract as per the contract terms, then the employer or the owner of the contract can call on that performance guarantee. The bank will honor that value embedded in the performance guarantee.
That's interesting. That's like if you don't deliver, you back me. We have 30 seconds. So again, registration, everything else.
Yes.
What do you need from me to back up my performance in that style?
Still, as I've said, first of all, you must show us the contract, because we must take comfort in what are the terms of the contract. You must submit a form application to the bank. Now, the DFC is quite flexible. that with only 30% security,
Yeah.
we can offer you a performance guarantee. So we'll need some kind of security. It could be a landed title, it could be
Yeah.
some kind of cash.
30% of the contract.
No, of the performance guarantee value.
Okay.
Yes, and usually performance guarantees are on average, usually 10% of the contract price. So if our contract value was 100 million, usually employers or the owner of the contract will require a performance guarantee of about between 5 to 10.
Okay.
So if it is 10%, then the performance guarantee will be about possibly 10 million.
Okay.
Yeah.
We couldn't finish. I know there are some nitty-gritty things I am burning to ask. However, I've been told their time is up. Thank you very much, Cuthbert Semwanga, Manager Trade and Finance, DFCU. I can see your expression that I wanted to say something, but they told me time. Later on in next year, we'll have more time for these things, and I will invite you back to tell us more about the instruments banks offer to enable business people to do their work.
Sure.
That was the link tonight. I hope you learned something about bid bonds and performance bonds. They are given by banks, and tonight we had DFCU explaining these things. Thank you for joining us tonight. That was the link.